The 100K portfolio has officially climbed to 119,384, up 19.3% year to date, outpacing the S&P 500's roughly 12% return. And in the last month alone, it added $9,630, up 8.77%. So today I'm breaking down the exact positions, moves, and market signals that help me stay ahead of the benchmark. So before we dig in, a quick note. This video is for educational and informational purposes only, and it's not financial advice. Always do your own research before making any investment decisions. This week was another reminder that markets seem to always move in a straight line. The S&P 500 ground higher despite constant debate about inflation and interest rates. Tech stocks led early, energy rotated into strength midweek, and crypto caught a bid late week. So under the surface, market breadth improved. More individual stocks participated in the rally, and the volatility stayed contained. My proprietary market monitor, which I use as a real-time filter for the market internals, remains firmly green. That green reading signals that liquidity, momentum, and participation continue to favor risk-on assets. So historically, when the monitor flashes green, we tend to see 1 to 3 weeks of upside follow-through. So I'm staying constructive while keeping an eye on sector rotation and sentiment. So for anyone new to the channel, this account is a 60-40 plus portfolio I originally built for my newborn son. The concept is simple. Keep the diversification of a classic 60-40 portfolio, roughly 60% stocks and 40% bonds, but add a few twists that allow it to move faster than the traditional mix with limited downside. So here's how it breaks down. Fast-moving equities are about 50% of the account, small cap growth, AI robotics, consumer defensive, biotech, solar, and even a bit of crypto exposure. These are positions that can sprint when the conditions are right, like right now. So options and leaps, I have about 9 to 10% in this tranche, a handful of long-dated call options that I sell covered calls against for extra income and asymmetric upside. And then fixed income and high yield, I got about 35 to 40% in this tranche. So long-term treasuries, high-yield corporate bonds, preferred shares, and mortgage REITs. This sleeve provides a balanced and steady cash flow because I don't want to keep adding to this account over time. And the speculative slice, a small but deliberate allocation to Bitcoin and other high beta trades. This keeps the portfolio lively and captures upside that traditional 60-40 portfolios usually miss. That combination lets me lean into growth when the market offers opportunity, but still sleep at night when the volatility spikes. So let's move on to the weekly heat map. You can see a lot of bright green here, which tells the story of how the broad strength was across all my holdings. So instead of just rattling off numbers, I want to give you guys context on the key drivers. So both the explosive movers and the slow, steady contributions that often go unnoticed. INOD, ticker symbol INOD, stole the spotlight this week. It jumped about 63% and is now up 81% year to date. The chart finally broke out of a long consolidation base, and the demand was obvious on the tape. So next, Tempest AI, ticker symbol TEM, added about 12% this week and another 15% intraday today. This name continues to ride the AI enthusiasm and is pressing towards that $100 target I've talked about for months. Next one is BTBT, my Ethereum treasury play. It surged 21% this week, carving out a higher low pattern that sets up a potential run towards $5 if the crypto momentum continues. And international exposure also paid off this week. So Stone Coal in Brazil gained about 9.5%, while the Canadian miners quietly chipped out steady gains, and my China and Israeli positions held their ground, giving me diversification without a drag. What I like here is the balance. High beta names rallied, but even the more defensive consumer defensive stocks and robotics positions participated. This is exactly why I stick to the 60-40 plus framework. I don't have to guess which sector will lead every week, even though we try. Different sleeves can take the baton at different times, allowing the portfolio to compound steadily. And hey, thanks again for sticking around. Just wait a moment, because in a moment, I'm going to show you this week's quiet superstar. It wasn't a tech stock, it wasn't crypto, it came from the fixed income side and delivered about 6% gains in just a couple days. That trade is a perfect perfect example of how this portfolio generates alpha in places most traders overlook. So that covers the equity engine and how the strategy sets the table. Up next, we're going to dig into the fixed income sleeve, the options hedges that protect the account, and also some specific bond trade that outperformed many stocks this week. So while traders chase momentum in tech and crypto, long-term treasuries, high-yield corporate bonds, and preferreds were quietly grinding higher. My mortgage REITs, NLY, DX, AGNC put another solid week as yields eased, proving once again why I hold them as a core source of income and gains and a ballast in the portfolio. But the standout performer, as I traded and I teased earlier, was MGR baby bonds. I initiated this position for a yield around 7%, expecting steady income. Instead, over the past couple weeks, it's already up about 7.5%, and based on credit backdrop, I see really the realistic path to $28. So this is a great example of how the 60/40 plus portfolio design lets me capture alpha in places many investors overlook. So why does it matter? Because most investors treat bonds as a sleepy afterthought. But when rates and spreads move even slightly, the price action can be pretty dramatic. Having a sleeve that can quietly generate a week's worth of equity-style gains without the volatility gives me staying power when equities eventually cool off. So it also reinforces one of my core beliefs, income as a weapon. That steady cash flow lets me be patient with higher beta positions and gives me the flexibility to add risk when the market monitor flashes green, like it is right now. So even with the market monitor solidly green, I'm never without protection. I continue to run that QQQ put spread, a relatively inexpensive hedge that pays if we get a sudden tech-led pullback. It's not a huge position, but it gives me peace of mind and protects capital if the sentiment flips quickly. On the offensive side, I opened up some small RXRX call positions and a handful of Japanese yen calls in the VXY. Both are inexpensive plays on potential pullback in the US interest rates and a weaker dollar. If the Fed hints at a pause or if global money flow shifts, these trades can deliver some nice upside. They're not headline grabbing, but they quietly add optionality, another advantage of running a diversified sleeve. So this week reinforces an old but powerful lesson. Patience pays off. Okay, some of my best performers like the baby bond and a few other AI names spent weeks looking flat before the move. Because this portfolio earns steady income from bonds and covered calls, I could sit through those quiet periods without feeling pressure to overtrade. And that patience often creates the biggest gains. So here's how the major sleeves stack up after the week. The equities, strong gains across AI, crypto, and international positions. The leaps, small but meaningful contributions through premium collection and the hedges. And the fixed income, anchored by MGR and many of these long-term bonds, saw steady returns from also the mortgage REITs and the preferreds. And the speculative slice, Bitcoin exposure and some of the crypto adds a touch of volatility, but held its ground and provides optional upside if crypto continues higher. So where do we go from here? As long as the market monitor stays green, I'll maintain a bullish tilt, letting the winners run while keeping hedges in place. I'm watching SPY around some key levels and in next week's economic data and also the Fed meeting next week. So the current portfolio value is $119,384. We're up, $9,630 over the month, and the year-to-date performance is about 19.3%, still well ahead of the S&P 500's 12%. Hey, if you found this breakdown helpful, tap that like button and subscribe so you don't miss next week's Monday weekly market signals video, where I'll dig into the SPY and other major markets for any clues using my market monitor. And hey, drop a comment below which sector you think leads into next week, and I'll try to talk about it on next week's video. I read every comment, and your ideas often spark great discussions for future videos. And with that, I hope you guys have a great weekend, and cheers. Take care.